So thank you very much for the advertising. I like that. That was a very good intervention. Now, more seriously. Okay, so if I summarize a little bit, I see that what you are aiming at is that there will be, on the one hand, like life insurance companies that are going to do their own like business and will have like sophisticated tools as we saw with AXA. And there will be like less sophisticated life insurance companies that will go towards banks because their business is really to risk manage, in a sense, risk in terms of the market risk. If I go back to that and continue on the advertising, in a sense, what about independent valuation? Because it's our business, so I'm very interested in getting your idea about if the market for variable annuities would have the same kind of need, in a sense. In structured product, we see like more and more like people asking for transparency, independent valuation. Do you think because of this culture of coming from the structured product side that it's going to happen as well in the variable annuity business?
I think it's essential that, especially as we move towards a Solvency II world, insurance companies properly understand their risks. Hedging is getting more precise, valuation is getting more precise, and asset liability management is getting more precise. It is essential that at every level within an insurance company there is a deep understanding of what the risk that has been taken on is and how it might change and how it might evolve. So the ability to price the risk precisely and independently from your hedge provider, whether it's a bank or whether it's a reinsurer, is already, I believe, but certainly will become more and more critical over time. Now, and this is the second advert, but for pricing partners, but I think that the idea of having an independent party that actually pools the know-how makes much more sense than development of models in-house. As a bank, we have about 40 or 50 quants. Certainly our banking peers will have that and more in their houses, and these people are developing models all the time. Within an insurance company, that team will necessarily be smaller, and in order to stay state-of-the-art, it's necessarily essentially for them to pool their resources on the modeling side. So I do think that the use of an independent entity will be very useful.
Thank you for the advertising. So coming back to like pricing and challenges in terms of daily risk management of variable annuities, how do you think, or what are your key recommendations in terms of managing operational risk? Because we mentioned, okay, risk in terms of market risk, we mentioned basis risk, which is more like fund selection, but what about like the day-to-day mechanism? In a sense, Laurent Bollard from AXA was mentioning that they are valuing, in a sense, hundreds of thousands of policies. So could you explain and could you give ideas of how we can better like risk manage this operational risk, and how like banks can bring some added value in that?
Well, I think I mean once again I'll be talking about product design, but it's key that the sort of flexibility that was proposed in the past to US policyholder, for instance, the ability to switch from any fund to any other fund from a large universe of funds out there, is definitely something that we want to prevent from happening in the future. This is definitely something that will drive the operational cost involved into designing a variable annuity product up big time. So that's one thing. Once you actually narrow down the selection of funds or underlying to a few, and also you spend time ahead of the marketing of the product, trying to match basically the IT operations of both companies, the insurance companies on one side and the bank company providing the hedge on the other side. You definitely minimize the risk of glitches on the operational point of view.
Okay, Alexis, or do you want to add?
One thing, I sort of alluded to it earlier, but hedging the market risk in a variable annuity is not about constantly reducing your exposure to the Greeks to zero. If you do that, you will lose money. You will lose money, hopefully not too quickly, but it'll be a steady drip, mainly because you will always hedge just behind the move, and secondly, because you will always cross the bid-offer spread. So for these two reasons, these frictional costs, you cannot take that approach operationally to managing a variable annuities business. Just like a trader in any side of the financial markets will not take that approach to hedging his book. What you have to do is have an infrastructure and a system that allows you to make decisions slightly ahead of time. And most of you want on average those decisions to be more correct than they are incorrect, but that is essentially how you risk manage this position. It is not simply a question of getting a number on a screen from an effective model and then reducing it to zero by trading futures or swaps or variant swaps or anything like that.
Okay, just okay, if you cannot narrow down like the numbers to and you cannot like really properly like delta hedge because you want not to stick to the Greeks. I'm interested in something which is longevity risk, because it was mentioned that that's something that is at its infancy in a sense, and it's like emerging. According to you, what kind of evolution do you see for longevity product? Because that's something like currently like is emerging in the market. I saw that a few banks are thinking about doing it, but still like there is no liquidity. We have the opportunity here to have in the round table the banking side represented. According to you, do you think the longevity market is going to develop so that it's going to provide more liquidity in the variable annuity, or what would be your opinion on that?
Well, we see definitely an emergence of a longevity market. Not everywhere. It's mostly concentrated in the UK, and it's largely eliminated by reinsurers. So now, where does a bank actually can fit in? The job of a bank is not, and I don't think it will ever be, to take longevity risk in our books. We will definitely rely on the insurers actually to take that risk. The bank can actually act as intermediaries for this longevity swap market, and that's what actually a few banks have actually started doing. So yeah, with respect to actual risk, and this is a position that we have at SocGen, we open to taking some, as the case may be. Mortality, for instance, lapses is also something that we've looked at recently, but longevity is probably out of the way for the time being.
And what about Commerzbank?
Actually, we match that very closely, so I won't really add. I mean, I think that in terms of pure longevity transactions, there is a role for us to play as intermediaries, partly simple intermediaries bringing two parties together, but partly also a kind of regulatory arbitrage that enables us to channel longevity through a derivative structure and make it cheaper from a capital perspective. So this is a role we can play, but on pure longevity risk, I completely agree with Emmanuel. I don't think it's our business.
What about ABN AMRO?
I have no specific idea about longevity risk. It's not my core competence.
Okay, so I think now it's time for question. So feel free to ask for the microphone so that the panelists will be happy to answer.
How do you handle your Greeks, and how does it comes in the modeling? And there is a very strong interaction into the two. What you have to be very careful, and it's come back to Emmanuel's comments on the product design, and I think we are very much on the same line at Barclays. Is, I mean, if you design a product that is too complex because you say, well, I'm an insurer, so I can live on a long-term basis, I can live on a complex product, and through time it will work fine. In reality, one of the risks you are taking is that you're gonna have that price externally, and there is some parameters in this pricing, for instance, correlation between the various market factor, or correlation between the longevity or mortality risk and one of the market factor that you assume somewhere, maybe at 50%, and then suddenly the market is developing and the market is telling you, hey, it's not 50%, it's 90%, or it's 10%. And you're going to have a huge discrepancy in your book because you were marking your book there, and suddenly you are selling option that was that. And that's exactly what happened in banks in certain exotic products, namely credit correlation books at one point when a correlation market developed. And that's a key risk that insurance companies have to pay attention to when designing product, because even though you are not really marking to market those products now, it will come, and it might hurt very much when some of these market factor will develop. So that's where the product design, simple product design, splitting the risk is I think it's the way forward, and moving as much as you can of the market risk to banks is also the way forward.
So thank you for the comment. Do we have any question?
Talking about business, we saw that the sales in the US were about $150 billion per year. What are your expectations in Western Europe in the coming 3 to 4 years?
Well, I will quote once again my colleague from Barclays, who at the beginning of his presentation showed numbers ranging from, if I remember right, 300 billion to 600 billion by 2020, which is something definitely which is optimistic, I would say. Well, I think that realistically, if the variable annuity market just achieves something around 50% of the lower bound within 10 years, it would be quite a success.
Hi, good evening. Just simple question. When you look at the product on the market, charging an average probably 4% a year when you add up, management fee of the mutual fund, then the guarantee fee, then you have the management of the UC, the unit linked, and then you promised to the policyholder a minimum return. Well, the question then is, you need to come up with a performance engine that are quite powerful, I would say, if you really want to sell a product which is really performing and delivering a huge amount of savings when the policyholder will go for retirement. We have discussed a little bit about asset allocation, those performance engine. Over a cycle of 10 years, we know what could, how asset allocation could work or could not work, actually. What are the, well, what we should follow then, whether we should decrease the fees if we can, because hedging will be less expensive. How you handle this issue, right?
Actually, Japan's a very useful example of that, where rates have crushed the possibility of providing returns over recent years. I think now, for the first time, I came back from there 2 weeks ago, and probably it's the first or the second trip in which I've heard distributors, who are the people actually who hold the power there, talking about reducing their margins. So I think that we as an industry do have to respond to market conditions. We can't provide products that will never do anything, that are essentially a pure money market deposit. I think there is a need to take some kind of market risk on the actual, well, actually interest rate risk on the margin side. So invest in the future when interest rates go up to actually earn more fees. Certainly, if you're killing the product, then the variable annuities will have no future.
Maybe to add on top of this, definitely reducing the fees from the distributor end is key to bring more value to the product. But also one thing, and I think it's a matter of its cultural aspect. Once again, if you look at what are the successful products that are actually being proposed right now in Japan, those are actually capital guaranteed products, usually 10-year, with linked to allocations of funds, which have actually a very, very low volatility control mechanism, typically target volatility around 3 to 5%. So now when you say that to a distributor here in France or anywhere in Europe, they will say, wow, 5%, are you kidding me? It's nothing. Actually, if you look at, on the long term, having a 5%, which is a low target volatility, and allowing yourself an allocation between bond and equities with specific momentum type of criteria, for instance, and volatility control mechanism, you can definitely achieve a very nice performance, something around 8 or 9%, and still have guarantee fees that are actually in the lower end of the spectrum, probably around 1.5 or 2%. So here, I think it's a matter of responsibility of the distributors to try to educate a bit more, first the brokers, the distributors, and the end clients as to what are the relevant level of volatility and risk that you should actually consider for long-term and retirement investment.
Yeah, and to add to that, I think the example of the US is definitely a proof that the variable annuity business has been a sustainable business because it has been there for years, for like a decade. I think the issue is more like in terms of education. So now I'm going just to ask for, we have like time for one or two more questions.
Moi, j'ai une question qui porte plus sur les perspectives de marché. Est-ce que les variable annuities ont vocation à devenir un produit de masse, compte tenu du ticket d'entrée pour l'épargnant qui va souscrire le contrat? Et comment allez-vous gérer aussi, dans l'avenir, les tranches autour de 50, 70 qui vont souscrire, qui vont aussi avoir des risques de maladies accrus et de maladies graves accrues?
Okay. So to answer the second part of your question, which is basically just targeting all the type of people subscribing to variable annuity type of products, I think everything has a price in the sense that, well, the probability of death when you are 70 is definitely higher than when you are 50, and that's typically what insurance companies actually take into account when pricing the product. If I remember right from the AXA's presentation, they were actually telling you that if you actually subscribe to the product when you're 60, you will have a 4% guaranteed lifetime residual benefit. When if you just withdraw at 65, your actually income can actually go up to 4.5, which means that essentially insurance companies are pricing the mortality, the higher likelihood of mortality. I'm not sure the numbers are right, but.
Maybe an insurance company want to comment? Laurent?
Yes. Well, I think that on this aspect, it is as you said, it's priced in the product. There is also not only the current mortality table, but there is also a strong analysis about the way this mortality table are going to evolve through time. So it's not only the current situation, but also what we call the drift, so the trend of the new mortality over the next 20 or 25 years. So it's taken into account. It has a price, but it's a risk that is managed directly, and it's taken into account right now in the product.
And as a moderator, I need to just mention, you didn't answer to the first question, which was, is variable annuity a mass market? Can you answer to that? Although we have spoken about over the last two roundtables.
Yeah, I mean, I think it's very much a mass market product. We're all reading the papers every day. We're looking at our governments have more debt and less money than ever before. The comfortable benefits that we're used to having are slowly going to reduce in real terms at least. And we need a product for the mass market, and it's our obligation, I think, to develop products for the mass market. I think when we do, I mentioned a bit earlier, we need to make them simple. It's not about selling complicated payoffs or complicated underlyings. We need a very simple, very transparent, and very stable product for the mass market. Variable annuities is that product. variable annuities can also be the product for the high net worth individuals who want a lot of flexibility, who want a lot of options, and are prepared to accept a little bit less transparency in the product they buy. So we shouldn't look at it as one product. It can be both these things.
Okay, time for a last question. So if we don't have, je vais repasser en français puisque on va introduire le discours de clôture.